A fitting case study of the Nikkei 225 index, the benchmark Japanese stock index, since candlestick charting can trace its origins back to Japan. An evening star leads to a major downtrend where there are strong three black crows formations that leads to temporary downward overextension at times. After returning back to upper intermediate ranges, the Nikkei is mainly confined in this narrow range. This is mainly held in place by very defined swing points, and eventually there is increasing bearish sentiment to breach the lower boundary decisively for a likely downtrend. There is a decline, however, bearish advantage is not maintained, because even before this upswing in April, there was a significant decline in red, bearish price action and volume. Initially, this was more of a passive rise, however, it was quickly accelerated due to the emergence of bullish continuations in the form of three marching soldiers and three methods rising price action. Also, take note of these dojis in strong directional context, leading to a swift upswing and sizable downtrend. 21,000 is a firm resistance, however, it is steadily passed with the emergence of three methods rising price action to varying degrees. There is a developing downswing from a hanging man that also had dark cloud cover follow, a less strict dark cloud cover with larger wicks and major overlap. However, this does still increase bearish sentiment, especially with stronger closes lower and increasing volume. There is a short-lived bullish rise back above 23,000 due to this one single large bullish candle and adequate volume above normal levels, and this eventually gets reversed as bearish sentiment quickly re-emerges, demonstrating a clear three black crows formation on a very large scale following the break back below 23,000. As with most all examples of three black crows price action taking the market down on a near vertical decline, there is eventually downward overextension. Bearish sentiment gradually shifts more bullish with increasing amounts of longer lower wicks. There is continued support around 21,000, leading to a gradual rise. Another passive rise, mainly due to the downward overextension, where selling pressure has almost been absent. Here there is a strong bullish incline with gaps between the candles closing higher. However, volume is more modest at near normal levels. It isn't exceedingly high, but it remains consistent. Short-term resistance emerges mainly from the two large bearish candles from the final downward overextension. Here they're opening prices with the highest selling volume. Clear price action with a doji in a bearish context that also forms an evening star. This is followed by clear three black crows price action for a very sharp downswing. Here is a doji in a bullish context, and that leads to a morning star, not so symmetrical but still the general U-shaped price action. Bearish sentiment remains to hold the market down, however it is quickly subsiding, and in the presence of this less strict piercing pattern, the market eventually shifts back towards a more bullish stance with increased buying around this lower boundary. Some spikes of selling pressure remain, however, the overall uptrend remains strong, which is also helped by the immediate confirmation of the less strict piercing pattern with this bullish kicking pattern, with increased volume as well. Defined trading ranges emerge with familiar candle patterns forming the sharp swing points, to further highlight the continued influence of these previous levels of significance. Another familiar situation, a longer-term downward continuation that becomes overextended when the final phase sees 3 black crows price action. An early upswing begins after a harami, and most of the bullish context comes from this doji that has a slightly longer lower wick. Naturally, there is opposition at the 20,000 level, though an uptrend continues to develop as this bull hammer rejected lower prices. It is another return back up, and along the way there are familiar candle patterns such as this bull hammer that forms a harami with the prior candle to sustain the uptrend on the key 21,000 level. These long-term highs continue to hold the market down, and that leads to another major downtrend. Along the way, there are no major upswings. However, these prior levels of significance continue to influence the market with their secondary support characteristic where they delay the downtrend. Not surprisingly, distinct bullish candles often form during these occurrences.